Welcome to CEF Insights, your source for closed-end and interval fund education, brought to you by the Closed End Fund Association. You're listening to a replay from the Advisors Summit on closed-end and interval funds. This session on equities and preferreds is moderated by Jeff Margolin, Senior Vice President and Closed-End Fund Analyst at First Trust, and features Andrew Cole, Portfolio Manager and Senior Investment Director at Aberdeen, and Robert Wolf, Executive Vice President and Chief Investment Officer at Stonebridge Advisors.
Good day, everyone. We've got a really great panel now on strengthening income portfolios with equities and preferreds. We have two great panelists and portfolio managers here today to talk to us about these structures, these topics. Andrew Cole, who's the portfolio manager and senior investment director at Aberdeen. He's a PM at AGD and AOD. And we have Rob Wolf, who is the executive vice president and the chief investment officer and the portfolio manager of several funds. I just want to note briefly that Stonebridge is, I'm with First Trust Portfolios. Stonebridge is an affiliate of First Trust, and First Trust is the investment advisor on the closed ends and ETFs that Stonebridge manages for us. But let's now talk about preferreds, talk about equities, two topics which are getting a lot of attention from investors. Certainly, performance has been good for equities and preferreds so far year to date. Rob, let's start with you. This is kind of a two-part question because preferreds are still a unique asset class. Not as some investors may not be familiar with preferreds as they are with, say, equities. But can you walk us through what makes preferred securities and hybrid securities distinct from common equities and traditional fixed income? What are the key characteristics of preferreds that make them attractive, in your opinion, for income investors? Potential tax benefits. I know there are fixed rate preferreds, floating rate preferreds, fixed to float. So the different structures, give us an education here on preferreds to start us off, please.
Yeah, absolutely, Jeff. It is a distinct asset class and a bit of a niche asset class in that preferreds and hybrids are often referred to as a mix or hybrid of equity and debt. So they sit in the capital stack above common equity and below senior debt. They come in the form of either preferred shares, or they can be structured as a hybrid capital security that's junior subordinated debt or sub debt, and that would rank a little higher than a preferred but below senior debt. They're typically issued by banks, insurance companies, utilities, although we have started to see some issuance from telecom and in the energy sector. And in terms of why they're issued, preferreds count towards regulatory capital for banks and insurance companies. And then for utilities and other non-financial issuers, they can receive some equity credit from the rating agencies. So that helps with keeping leverage ratios low and being able to issue some capital that counts towards equity for those types of issuers. In terms of how they're structured, they're generally debt-like in that they have fixed dividend payments or interest payments. They're issued at a par value like a bond, and they are redeemable. They're either perpetual in the case of a preferred, or they have long dated maturities for hybrids, but all the issuance is callable, and it's typically either 5 or 10 years out from the issuance date. And like bonds, they do have interest rate sensitivity, and so you do want to look at the duration of the securities and see how that might impact your investment. The equity-like treatment comes from the fact that they are perpetual, as I said, or longer dated, but they also can be deferred at the option of the issuer in terms of their coupon or dividend payments. In the case of banks, regulators could mandatorily defer some of those payments. However, given the generally high quality of the issuers, it's a very rare occurrence. So, typically when you look at what investors are looking at in terms of their allocation towards preferreds, I would say it fits in the fixed income side of their portfolio. And we typically see investors put about 10 to 15% of their money in the preferred space, just given that the size of our universe is around 750 billion in size. So it's really kind of a small part of the fixed income universe, but definitely an important part of it. And the key kind of attractive features of the preferred market really are the high income coupled with high credit quality. So in the current market, for example, we're looking at current yields around 6.25%, yield to worst somewhere around 6% for the market. New issuance in our space, which has been very robust this year. I think we're on pace for a record this year in terms of issuance, has averaged closer to 7%. So you are getting a nice pickup relative to other fixed income, for example, versus investment grade corporates. You're probably picking up around anywhere from 175 to 200 basis points versus an IG bond. And you're not really giving up much in terms of high yield bonds either. So now I did mention the high credit quality that you get with that high income. And as an asset class, the average issuer in our space has an average rating of single A, and that's at the senior debt level. Now, preferreds do get notched lower by the rating agencies because they are subordinate to senior debt, but at the security level, they're triple B minus. So still very high credit quality for the type of yields that you're seeing in our space. And that high quality also comes from the concentration, as I had mentioned, in banks, utilities, insurance. Those three sectors make up about 75% of the market. And when you look back over the past 40 years, those three sectors have by far had the lowest default rates. Now, the last thing that I'll mention in terms of kind of a benefit on top of that high income, you do get some tax benefits. So most dividend paying preferreds provide qualified dividend income or QDI income, similar to what you'd get on a common equity. And then some also provide dividend received deductions or DRD deductions for corporate investors. Interest paying hybrids are taxed as ordinary income. But what we try to do with our funds, and I think what other active managers do as well with many of their funds, is they'll try and maximize the QDI income distribution for investors by prioritizing that QDI income on the distribution and then reserving some of the ordinary income for fund expenses. So that can help boost that benefit when it comes to the distribution. I think you had also maybe asked about the difference between some of the coupon structures out there in our market, and it is unique to our market that we have varying coupon structures. So some of the market, especially the $25 par or exchange traded market, which many investors are probably familiar with, is typically just a fixed rate, fixed coupon. So these securities will have a fixed term for 5 or 10 years. If it's not redeemed at its first call date, it can extend at that fixed rate. Fixed to float is another coupon structure that we see in our market, although we've seen less issuance from in that coupon structure, just given that the market's moved on to more of a fixed to fixed coupon type. But in a fixed to float structure, coupons are fixed for the first 5 or 10 years of their life, and then they'll reset off of SOFR every 3 months to give you that floating rate coupon after. And then the final structure, which I had mentioned, the fixed to fixed reset, that's the most popular structure that we're seeing, especially on the institutional or $1,000 par side of our market. And those are fixed for 5 or 10 years, and then they'll reset for another fixed period of 5 years, typically spread off the 5-year treasury. So when these securities are issued, a reset spread will be determined based off the original coupon less the reference rate. And then when these securities reset, they'll reset off that reset spread plus the reference rate, which, as I noted on the fixed to fixed securities, is typically 5 years. So, you've got a lot of interesting characteristics, many of which I didn't even bring up here, hours to go through all of it. But I think the big key aspects really are the high income and the high credit quality that you get with these securities.
Thank you for that, Rob. That's the education that we needed. So good way to start the panel. And now we'll switch gears and move to equities and talk to Andrew about his funds, his strategies. And Andrew, what's unique about your investment strategies at your funds? And from your standpoint, why do you believe advisors should allocate money to the funds that you manage?
Yeah, absolutely. Thanks, Jeff. And we do think we manage some unique dividend income products here at Aberdeen. So what we're able to deliver to our investors is a fairly high distribution yield that is generated through a combination of owning dividend-paying stocks, and then we supplement that with what we call dividend capture. So we allocate just a small portion of our fund, usually 5% or less of the total assets, into this strategy where we're constantly investing in companies paying dividends in the next several weeks and rotating that capital through dividend paying events throughout the year, generating a decent amount of extra yield for our investors. So we think what's great about that relative to some other alternatives that advisors may have is that typically dividend paying funds tend to be focused on some of the stodgier sectors of the economy like utilities and telecoms to generate their higher yields. What we're able to do is invest across the sectors and geographies to give you more interesting and dynamic exposure. So, for example, tech is our largest sector holding, which is, I think, a bit unusual for a high income fund like our own. And then the other option that you can look at is, strategies that employ derivatives and covered calls to generate their income. But those funds tend to lag when the markets are rising, like we've seen this year, and because the covered calls capture upside. So we think we provide, a fairly unique opportunity to participate in market upside, all the while generating above average dividend yield.
Thank you for that, Andrew. And want to switch back to Rob and get his views on how he believes advisors should think about the risk profile of preferreds in portfolios, especially given the economic and interest rate environment that we're in. And you, as a portfolio manager, Rob, you and your the team at Stonebridge, how do you evaluate credit risk and other risks such as call risk or extension risk when you look at preferred securities?
Yeah, so I think the key risks, as you kind of highlighted there, interest rate sensitivity, credit risk, and then the call or extension risk. And preferreds are rate sensitive, as I had mentioned, so they may underperform in a rising rate environment. So you need to manage against that in terms of managing the duration, and you can use those varying coupon structures that I had mentioned to adjust your duration of the portfolio. So the fixed to floats and fixed to fixed tend to have lower durations, while the fixed for life or fixed rate coupons tend to be longer duration. But in a late rate cycle or rate stabilizing phase like we were in for the past year or so, and then starting to cut rates over the past year, I think preferreds can really start to shine and outperform, and we've seen some solid returns over the last couple of years in the high single digits. And we've done some analysis on past rate cut cycles. Preferreds have performed positively through every rate cut cycle that we've looked at over the past 30 years, and they've averaged an annualized return of about 5.5%. So I do think you can manage through that interest rate sensitivity, but you do really need to actively manage against that by adjusting the durations of your portfolio. Credit risk is always something that you want to consider, especially in a scenario where you may be facing, declining economic conditions like we could be seeing over the next 12 months. So given the high quality of preferreds like we discussed, it's not as big of a concern for our market, but you do need to look at the credit fundamentals for every issuer. Our team does that at Stonebridge, and banks, utilities, insurance have been very good, but you may, want to look towards reducing higher beta sectors like we've been doing with our portfolios, cutting back on energy or some other parts of the non-financial space where credit quality may be something that comes up in question. Like, for example, some issuers in the health space and consumer finance are areas where we've avoided those issuers just given the risks associated with the potential for a recession in the current environment. And then I think you touched on call or extension risk in your question as well. And I think advisors need to be mindful of the call provisions for each issuer, and then also the economics of the call for each issuer. And so that's something that we'll look at, does it make sense for them to refi a current security, or are they going to let it extend? You have to look at the structure of the security. As I had mentioned, reset spreads come into play with some of the fixed to float or fixed to fixed securities. So these are all varying factors that advisors need to consider when they're putting together a portfolio of preferreds or hybrids.
Thanks, Rob. And Andrew, I want to switch to you now and get your sticking with the theme of factors to look at when managing portfolios and evaluating securities. I'm very curious, Andrew, how macro factors and geopolitical factors impact your investment process at Aberdeen and your portfolio process.
Yeah, thanks. Great question, Jeff. So certainly we are, we're all seeing the same things everyone else is, the heightened geopolitical tensions, the macroeconomic uncertainty, the barrage and litany of, tweets every day that send the market into gyrations. But frankly, we are bottom up long-term investors, and our focus continues to be on picking great companies at attractive valuations with strong fundamentals, good growth prospects, and great management teams. So we try to sort of be aware of the noise of all those things, but not let it dominate our investment process. So certainly we will meet regularly and discuss how developments in macro can impact our individual holdings and whether or not they change the investment thesis that we have for each and every stock. But we try not to be too reactive to the events that are going on. And I think, a good example of the danger of doing that is, just last week, President Trump, said he was going to raise tariffs on China by 100%. And the stock market sold off pretty nicely on Friday, and then over the weekend, cooler heads prevailed, and it was up again on Monday. I think down again on Tuesday, and then up again. So you can't sort of overreact to the macro, and the key for us is to think about how changes in some of these macro factors can impact the underlying holdings on a longer term basis. And when they do, we make adjustments, but otherwise we try to be level headed and not react to every new development.
Makes sense. Thank you. Rob, Stonebridge is an active manager. And as I mentioned, it's an affiliate of First Trust. I think it's important to reiterate that. But from your standpoint, what should advisors or investors look at when evaluating preferred closed-end funds and ETF preferred funds? And from that standpoint, how do you're an active manager, as I said, how do active managers add value in preferreds versus, say, passive strategies?
Yeah, so it's an interesting question, and it comes up a lot when we're talking to advisors and to investors. And I think the first thing, of course, is to look at the track record of the manager and the performance of the funds that they manage relative to other funds. And that's whether it's actively managed or passive, especially when it comes to ETFs. You typically only get active managers on the closed end fund side. But look at how they're managing the leverage of the fund. Look at the composition of the portfolio if you can get a hold of the holdings. Is the manager investing only in the exchange traded market, or are they investing across the entire preferred and hybrid universe? Especially in the case of an ETF, in many instances, many of the passive funds in particular only invest on the exchange traded part of the market, but that's only about a quarter of our overall market. And so you're missing out on access to the entire preferred and hybrid universe of institutional or $1,000 pars, which include AT1 securities from banks out of Europe. Much of the utility issuance is done on the institutional side here in the US. There's a lot of issuance that's now coming out of Canada from many of the high quality banks up there and some of the high quality telecom up there as well. And those have been very interesting securities. So you really want to look at that composition of that portfolio and see if if the manager is taking advantage of that. And then obviously, when you're looking at active versus passive, some of the advantages that you can pick up as an active manager are security selection, of course, and then also duration management. And so, as I'd mentioned, in the current environment with rates being a bit volatile, starting to see rates cut on the front end, it's important to have that manager that can adjust the duration of the portfolio and take advantage of those macro conditions and interest rate environment to benefit the portfolio. and you just can't get that with a passive fund. So from that perspective, I think, in my opinion, I'm biased, obviously, being an active manager. I think active management makes a lot more sense relative to passive funds. And if you look at historical performance over time, I think active funds have outperformed relative to passive over the long term.
Thanks, Rob. And before I get to both of your outlooks going forward, I want to ask Andrew, and then I'll go back to you, Rob, and then we'll close out with Andrew. But Andrew, as a portfolio manager, what are two or three things that keep you up at night in this environment that we're in?
Yeah, there's probably actually more than that
Yeah,
today, given all the things that are going on. But a couple of things for me that I don't know if they keep me up at night, but make me a little nervous is gold at 4,200 an ounce, silver over $50, Bitcoin reaching 125,000. What is that telling us? Is it telling us that there's some macroeconomic shock coming through? Or does it tell us that just there's rampant, speculation in the market right now? Neither one of those would be a bit concerning, if it were to come to pass. So that's one area that I'm thinking about. And the other is just complacency in the market. We're seeing, Rob probably knows this better than I do. Credit spreads are very, very tight, near all-time lows. The VIX is chugging along at low levels as well, and equity market valuations are very, very rich and near all-time highs. And those are all sort of warning signs that we've had a very nice run in the markets, and maybe we should be a bit more cautious here.
thank you. And I'll come back to you in a moment, Andrew, with your outlook and some closing comments. But I want to give Rob a chance here. One last question here. Rob, what's your outlook for the preferred market, and what are the catalysts you're going to be watching for over the near term?
Yeah, so I think the biggest risks to the market right now are probably macroeconomic and geopolitical risks that every part of the market is facing, whether it's the tariffs or some of the geopolitical events that are occurring over in Europe. So I think from that perspective, you need to keep an eye on those things, and that's kind of what's really the big risks in our mind to our market. But we've found that the preferred and hybrid market has been very resilient over the past year. Haven't been really any first order effects from tariffs when it comes to our market. And given the high yields relative to other asset classes, especially given the tight spreads that Andrew had mentioned across really all fixed income, you've seen a number of non-traditional investors move down into preferreds and hybrids over the past year. And I think that's what's helped driven the performance of the market up over 7% year to date. So with those tight spreads across fixed income, especially when it comes to IG and high yield bonds, and then even in our space, spreads are looking pretty tight. You have that, but you also have this elevated rate environment where you're still seeing issuance, as I had mentioned, closer to 7%. And so I think what we'll see with our market is that you're not going to see much in the way of appreciation, but performance is likely to come from income, at least for the remainder of the year. And then, as we start to see further rate cuts from the Fed, if we do see a cut in October and then maybe one in December, I think that'll continue to increase support for valuations in our space. So I would say, absent any major surprises, you'll get income and then the potential with those rate cuts for some small appreciation in the market.
Thanks, Rob. And Andrew, we'll give you the last word here, the final question. I'm very interested in your outlook for the rest of the year and looking ahead to 2026.
Yeah, so I think our outlook is appropriately cautious, but with some optimism that this market can keep moving higher. So obviously the geopolitical and macroeconomic stuff makes us nervous, and valuations are high. But what's great for our fund, investing in dividend paying companies provides a bit more of that support through the income. And while the market may be trading at 22 times next 12-month earnings, the holdings in our fund are less than that. So we're very happy to be bottom up stock pickers in this environment, looking for the opportunities that still offer good value. AI continues to be a theme that we're investing in, and we think that could be the thing that drives the market higher in the balance of the year and into next year, even with some of these risks that we've already mentioned.
Great. Well, thank you both, Andrew, Rob, for a wonderful discussion. As always, I learn so much when I talk to portfolio managers. So thank you to both of you. And again, thanks everyone for joining us.
Thank you for joining us for another episode of CEF Insights. Visit CEFA.com for more education from the Closed End Fund Association. This material is not and is not intended as investment advice, an indication of trading intent or holdings, or the prediction of investment performance. All fund-specific information is the latest publicly available information. All other information is current as of the date of this presentation. All opinions and forward-looking statements are subject to change at any time. First Trust, Aberdeen, and Stonebridge Advisors disclaim any responsibility to update such views and/or information. This information is deemed to be from reliable sources. However, First Trust, Aberdeen, and Stonebridge Advisors do not warrant its completeness or accuracy. This presentation is not intended to and does not constitute an offer or solicitation to sell or a solicitation of an offer to buy any security, product, investment advice, or service, nor shall any security, product, investment advice, or service be offered or sold in any jurisdiction in which First Trust, Aberdeen, and Stonebridge Advisors are not licensed to conduct business, and/or an offer, solicitation, purchase, or sale would be unavailable or unlawful.